Joining us for another day of panels, and thanks again to CJ and Caitlin for switching the format for us so seamlessly to Zoom. Just a couple of quick announcements before we start this session. One regarding CLE sheets. It's extremely important that you turn in your CLE sheets by Monday, October 12th, if you are viewing these sessions live. If you are not viewing them live, they are going to be recorded and they will be downloaded to the Attendify app next week. And we will be receiving an email next week when they have been posted. The new CLE affirmations will be posted next week, and you can then view any of these sessions again. And at that time, you can submit your CLE affirmations, and the new deadline for the recorded sessions will be January 15th. So you do have an extended deadline if you are watching these sessions at a later date. Another quick announcement is I am happy to report that yesterday's market update panel has been rescheduled to 4 o'clock today. Thank you very much to those panelists for agreeing to give the session again today at 4. That will be Chip Fisher's market update panel. Everyone except Mark Williams will be on that panel. I think most of you have already heard Mark's portion, and that will also be available for watching later. The codes, and also on the market update panel, the 2 codes are going to be presented at that time. So if you missed it yesterday, please join us at 4 Eastern today for that. And then lastly, I wanted to announce that the Attendify app is still up and running. So you can still get points for using the app. It's still active. It can be used to view the schedule. It can be used for the presentations, chats, posting on the activity stream, posting photos to collect those points for the prizes, etc. And so with that, I would like to now turn it over to Ann King to introduce her panelists for this panel, which is entitled Impact of COVID-19, Present and Future. This panel is going to explore some of the effects of COVID-19 on our market, some of the impacts that we've seen on various industries, resulting rating agency actions, trends and waivers and amendments, and expected increased workouts and bankruptcies as they start to affect our higher rated credits. Ann King is a senior counsel at Sun Life Capital. She's also a former trustee of the ACIC, and she was a co-chair of the education committee, so she's always been active in the college prior to joining Sun Life in 2003, and practiced with several law firms, including Dave Arian Howard and Palmer and Dodge. So with that, I will turn it over to Ann.
Thanks very much, Patty. It was really fun to see you, Patty, last night, and to see a number of our colleagues at the wine tasting. Really have been missing people. We've just been so busy, with our nose to the grindstone with our work that we really haven't taken time to connect. And one of the things that Tina mentioned in her speech today was that we really should reach out and, have a virtual coffee with a member, or find another way to stay in contact, just send an email, hey, how you doing? To keep up the collegiality of the college. So it's kind of frustrating not to be able to see people right now, but it's nice to be able to connect. And we have a great panel I'm very excited about. We have Luba Petrova, who is from Fitch Ratings. She's a senior director there. She started her career at JP Morgan, and she worked in leverage finance there, and then later on the risk management team. And she has been at Fitch for, I think, about 10 years now. Is that right?
4 years.
Oh my gosh.
I was at JP for 10 years.
And then she works on analysis of trends in debt documentation, corporate structure, recoveries, market dynamics. She works closely with the sector analysts on the credit assessment of speculative grade issuers and recovery analysis. So she will give us a great overview on how the rating agency has reacted to the pandemic. We also have Aisha Chatterjee, who's a senior associate at King & Spalding. She works in the leverage finance area. She had earned her bachelor's from a joint degree from the Wharton School and a Bachelor of Art in International Studies from University of Pennsylvania, and her law degree from Columbia. She is involved representing both borrowers and lenders, including private credit funds, private equity sponsors, institutional investors, public and private issuers, in asset-based lending, unitranche facilities, private placements, first lien, second lien transactions, liability management transactions, and restructurings. So Aisha will be giving us an overview of the amendments and new transactions over the course of the pandemic. And then we have Mike Riley, who I think most people know. He's been in practicing law for over 40 years. He thought he retired as a partner from Morgan Lewis, but that was when times were really good. Now the times are a little dicey. He has come back as a special advisor to the firm, handling bankruptcy and workouts and restructurings. He's advised institutional investors and lenders in a wide array of restructurings, not only in the United States, but also in Europe and Latin America. He's known for being a strategist with distressed credits, and he's been involved in a lot of the largest restructurings over the course of the past couple decades, and also many of those cases were cross-border cases. So he's also in the American College of Bankruptcy as well as the American College of Investment Law, which there aren't too many people who have that dual honor. So Mike will be giving us an insight into the increasing restructurings and bankruptcies in our space as those types of events start to move down the credit chain from or up the credit chain from the lower ranked investments, the lower rated investments, to the investments that we think of as being more secure. So with that, I want to also reiterate that you do need to get those affirmation forms in to cle@acilaw.org by the end of the day on Monday for these virtual sessions, as Patty mentioned. And also, I will be giving you the codes for getting CLE credit. So make sure you've got pencil and paper or whatever ready to jot those down. I'll wait a little bit into the presentation to make sure that anyone who had, difficulties getting in or whatever has time to get in. And I'll say them twice each time. So with that, I'm going to hand the floor over to Luba. As I mentioned, she's the Senior Director at Fitch Ratings, and she will walk us through the rating agency actions and the expectations for recovery trajectory, and the default forecast that Fitch has developed to date. Luba?
Sounds good. Well, thank you for this introduction, and we can move on to the next slide. Perfect. So let me start by walking our audience through the approach that we took institutionally when the pandemic first took hold. And this involved the portfolio-wide sifting process to identify issuers whose credit profiles and ratings were most at risk. We bucketed them in high, medium, and low exposure categories for the coronavirus, depending on their vulnerability to the disruptions caused by the pandemic. We also grouped them based on the degree of rating headroom within each issuer's rating. And we think of rating headroom as the cushion before the issuer's performance exceeds the downgrade rating sensitivities that Fitch has set for the issuer. These downgrade sensitivities usually include a number of different components, and at least one of them is a credit statistic or has a numerical value. Our focus really was on the availability of liquidity to withstand the initial cash strain caused by the shutdowns. And we were also focused on our assumptions for the post-pandemic sector recovery trajectory. So Fitch performed the sifting process globally, presenting the results to senior management. We were of the view that taking broad sweeping actions, such as putting everything on a negative outlook or a negative watch, would add very little value. And instead, our goal was to be measured and to identify the areas where we saw the most risk. And that, in turn, enabled us to provide transparency and to effectively articulate the assumptions that drive our rating actions. Among the industries that we identified as being most exposed to the pandemic were airlines, gaming, lodging and leisure, autos, restaurants, oil and gas, and non-food retailers. In terms of credit quality, because of the robust credit markets we had in the past few years, there was a significant rise in issuance on the lower end of the rating spectrum. And as a result, about 2/3 of our portfolio entered the crisis in the single B category or lower. And the largest cohort was actually single B minus. The majority of these issuers consist of privately monitored credit ratings, which tend to be concentrated in the middle market. This group exhibits high exposure to the pandemic, combined with relatively low rating headroom, and that can indicate a meaningful risk of migration to CCC.
Luba, do you find that there's a difference between how the rating agencies deal with private rating decisions versus public ratings?
It's a great question. So private ratings are subject to the exact same corporate rating criteria as public ratings. Both public ratings and private ratings fall under the same rating product, the rating, and therefore they have to be subject to the same criteria. Both are also a regulated product. There is no difference in the intensity or the analytical rigor that would go into the rating derivation process for a private rating versus a public rating. And if you take a look at the internal credit memo that a primary Fitch analyst would prepare and present to a rating committee, then you will see that there is no difference in the type of information or really the depth of analysis provided for a public versus a private rating. It's also worth mentioning that upon a request from the requesting party, a private rating could be converted into a public rating. Just like public ratings, private ratings are reviewed annually and are also brought to committee during the course of the year if there is an event that may result in a change to the issuer default rating or to the instrument recovery rating.
So it's more the source of the information that's the difference between the two, as opposed to how you use the information to develop the rating.
Yeah, right? I would say that's fair. It really comes down to who the requester is and how we would go about obtaining the information. We do have a minimum threshold of information and documents that we would need in order to commence work on a public rating or a private rating. We can move on to the next slide. Thank you. Yeah, so just a brief summary of the rating actions we have taken over the course of the pandemic. Since the start of the pandemic in the US, we have taken about 800 public rating actions in North America. This data is as of September. And here specifically, we're talking about downgrades or affirmations with negative outlooks or rating watches assigned. About 30% of our portfolio was placed on negative outlook or negative watch as of September. And for a little bit of context for what that means or might mean, the long run historical average conversion rate for a negative outlook or a negative watch into a downgrade has been somewhere between 50 and 60%. However, it is worth noting that there is some evidence that the conversion rate this time around may actually turn out to be lower. And one driver for that is that many of these issuers are in sectors that are very highly exposed to the disruptions caused by the pandemic. And the outlooks that have been assigned to them tend to have a precautionary element. Another important factor is that a large portion are in oil and gas, where we have recently seen a little bit of improvement in prices. And a third factor also worth mentioning, is also as important, is that this long run historical conversion figure that I mentioned, the 50 to 60%, was affected by increased downgrade activity on the back of years of rising corporate leverage. And we can move on to the next slide. So as we started going through our portfolio and our sifting process, our focus was on one, how much liquidity issuers had. Would that be enough to sustain the cash drain? And number two, what our expectations for the recovery trajectory looked like over the course of the rating horizon. And so if you take a look at the chart on the right-hand side of the slide, companies in the category represented by the green line have a little bit more robust uptick. And here we're talking about B2B sectors, manufacturing, technology, capital goods. Issuers represented by the blue line are expected to have a slower recovery. And this is on the back of high projected developed market unemployment and wealth deterioration, as well as a level of dislocation of the supply chains. Retail, consumer-facing businesses, discretionary business services, these would fit into this blue line category. And last but not least, the red line represents what our expected recovery trajectory is for issuers in sectors that are highly likely to continue to experience distress and at best a delayed recovery, again on the back of wealth erosion, social distancing, travel aversion, and general travel restrictions. And this is where we place transportations, hotels, and tourism and related sectors.
Why don't we pause now for the code? So everyone make sure you've got something to write down the code. The code is 17698. Again, that code is 17698. Thank you.
Okay. Well, if everybody's done writing this down, then we can move on to the next slide. Can we move over to the next slide? Thank you. Here. So in June, we published a report where we present our estimates for revenue destruction. We estimate that globally, revenue destruction would likely amount to around 8.5 trillion for 2020 and 2021. Not all sectors are equally impacted. And as you can see from the visual here, oil and gas holds the lead, followed by manufacturing, leisure and transportation, and retail. We generally expect that revenues for 2020 would be about 15% lower than revenues in 2019. And for 2021, we expect that median revenues would probably be somewhere between 90 to 92% of where revenues were in 2019, so 8 to 10% lower. It is worth mentioning, though, that different subsectors within the same industry can experience very different recovery trajectories. And that depends on their idiosyncratic susceptibility to the disruptions caused by the pandemic. Fitch generally expects a slow recovery from the fourth quarter onwards as a result of sustained high unemployment and a pullback from private sector investment. If we can move on to the next slide. Thank you. And here we have our first poll question for this panel. We wanted to gauge the audience's expectation for how default volumes over the 3 years between 2020 and 2022 would compare to default volumes during the Great Financial Crisis. So let's get some votes. CJ and team, I'm not able to see the progress. So when you have a critical mass, let me know. Oh, here we go. Okay. Okay. Very well. Well, let's find out what the answer is. If we can move on to the next slide. Excellent. So we forecast that the pandemic will bring about a multi-year period of elevated U.S. institutional term loan and high yield default risk, Our 3-year cumulative default rate forecast is about 70 to 20% for loans and about 15 to 18% for bonds. And as you can see from the chart, these numbers evoke the default rate numbers that we saw in 2008 and 2010, resulting from the global financial crisis. It may stand out to you that the forecast for the 3-year cumulative default rate for loans this time around is expected to be higher than the 3-year cumulative default rate for loans during the Great Financial Crisis. This is primarily driven by the proliferation of loans to highly leveraged issuers, especially in sponsored transactions. With valuation multiples on the rise for the past several years, sponsors have been relying on greater amounts of debt, and specifically secured debt in the form of loans, which tend to be the cheaper form of financing. And as a result, the amount of loans we see as at risk of default is higher. The 3-year cumulative default rate for high yield for 2020 and 2022 is a bit lower than it was in 2008 to 2010. What really drove the high yield cumulative default volume during the financial crisis of 2008 to 2010 was the 14% spike in 2009. And that's when numerous sectors reported default rates of some 20+%. And these sectors were widely spread, and they included banking, autos, cable, chemicals, gaming, paper and packaging, and a few others. And this time around, we expect a more consistent default rate of about 5% a year. Another important factor explaining the lower cumulative default rate for high yield this time is that in the energy sector, which constitutes about 16% of the universe, for high yield specifically, most defaults have already taken place. The combined 2021 leveraged loan and high yield default rates are expected to be most acute in leisure and entertainment at more than 40% and over 20% for retail and energy. This concludes my remarks for the panel. So I will hand it over to Aisha, who will go over developments on the documentation side of things. Thank you.
And let me just also mention that Fitch has generously shared some reports on the US speculative grade screener, the road back, the post-lockdown assumptions for global corporates, and a paper that Luba helped author on US corporates top revolvers as coronavirus raises focus on liquidity. So be sure and check those out on the website or on the Attendify app. They're not quite as visible. You know, we don't have them attached to the Zoom session, so just don't forget that those are available.
Yeah, thanks for the call out, Anne. Yeah.
Aisha?
Thanks, Luba and Anne. So before I go into the actual portion of the presentation, I just wanted to let everyone here know that King & Spalding has been doing a lot of analysis of the amendments that issuers and debt providers have been undertaking over the course of this COVID period to take a look at the trends and innovations that people are coming up with to handle this kind of unprecedented situation. So on the public side, as of this week, the firm has reviewed 946 amendments that were entered into after March 13th, and about 90 of them are repeat amendments where an issuer or company is coming back to the table for a second amendment within this period of time. We've been sending out a weekly update to our clients with updates on new amendments that have been entered into and new trends that we're seeing in those amendments. So please feel free to reach out to me if you would like to be added to that weekly distribution. So on the next slide, you'll see that what we're seeing in this analysis is that there are basically 3 phases of the negotiation of these amendments over the course of since COVID kind of hit the US. So you see the mid-March through mid-April period when everything is just kind of focused on emergencies and urgent needs of companies and handling that situation quickly. You saw phase 2 mid-April through early summer, where you see companies start to realize that this isn't going to be a short-term disruption and thinking about what they need to do longer term to make sure that they're avoiding defaults. And then phase 3, late summer through early fall, which we're in right now, is a period where we're trying to think of what companies can do looking forward, what they need to do in terms of their maturity dates and pricing to kind of stay afloat, while also making sure that debt providers are getting the protections they need. So on the next slide, going into phase 1, so obviously we all remember in mid-March, COVID's impact kind of hit the US very quickly, and issuers and note holders had to move really quickly to address urgent needs. So the key focus here was on avoiding immediate defaults. People were looking at Q1, maybe into Q2, and thinking, what do we need to do to make sure that we're not triggering any defaults under covenants, missing payments, et cetera, just kind of, looking at a fire and what you needed to put out. So short-term covenant relief was in the majority of amendments that you'd be seeing, where you'd see covenant holidays either for Q1, maybe for Q2, or if you weren't able to get an amendment in place in time, you would see waivers of potential defaults or events of default relating to covenants, financial performance covenants. Another thing that you saw a lot of, as I mentioned, was liquidity relief, right? A lot of these companies had dramatic impacts to their cash positions and revenues, and they weren't going to be able to make their Q1 interest or amortization payments. So you saw a lot of payment holidays for certain periods of time, and sometimes those payments were turned into PIK payments instead of cash payments, with some recovery of that payment down the road, either at maturity or maybe when things normalized again. As a corollary to the cash problem, for companies that had revolvers or other access to cash, we heard a lot in the market and even in the news about companies trying to access whatever cash they could and hold on to it. So you saw revolver drawdowns, often full drawdowns if that was available to a company, and you saw companies with maybe more solid performance at the time looking at delayed draw term loans and notes and incremental debt to hold on to whatever cash they needed so that they could ride through the coming period.
Ruba, how would the rating agency view these increased revolver utilizations? How would that affect the ratings?
Yeah, I mean, we certainly saw a lot of a big rush to lock in liquidity, especially as issuers started to realize what the shutdowns, social distancing, the travel restrictions would mean for business. High revolver utilization is not necessarily a credit negative in itself, but it would be fair to say that during non-crisis times, a full draw on the revolver could signal that a struggling issuer may be contemplating a bankruptcy filing. Where a drawdown could pose a risk to the rating is if the loan is not replaced with free cash flow, but is instead replaced by a permanent form of debt. And that could have a negative impact on the long-term leverage of the issuer and therefore the issuer's credit profile. You mentioned a report that we published on revolver utilization. We probably tracked about 350 issuers who accessed their revolvers. We documented the amount, the type of draw, the size of the facility, and company messaging regarding the use of proceeds where such messaging was available. Nearly 70% of the drawdown activity took place during the last 3 weeks of March, and that coincided with the spread of shelter-in-place orders across the US. Probably about 40% of the issuers we followed drew down all of the availability under their revolving credit facilities. Most issuers indicated that the proceeds would be used to bolster liquidity. And also a number of investment grade issuers reported that they're using the proceeds to repay outstanding commercial paper in order to avoid trouble due to dislocation in the CP market at the time. The top 5 most active sectors in terms of drawdowns were retail, gaming, lodging and leisure, REITs, technology, and consumer.
Michael, can you give us a sense for what you were seeing during phase 1 when it came to bankruptcies and restructurings?
Yeah, I think really phase 1 you saw the retailers who went into bankruptcy quite quickly, but frankly, most of them, in my view, were already on the tipping point edge anyway. And just the loss of revenue just was one more thing that put them over the edge. And we've seen, dozens and dozens of retailers file. Oil and gas, of course, was partially caused by COVID, but also partially by geopolitics with the Saudis and the Russians and the price war and things like that. But otherwise, in the early stages, everything was just a Band-Aid. Everything was, let's just push this down the road. And I look back now naively saying, well, maybe this will be over by summer. Maybe this will be over by fall. So we'll do a couple of quarters and see what happens. And of course, here we are looking ahead to 21, even 22, when it comes to some of the restructurings and amendments. And the summer was a little more quiet on bankruptcies, except for retail, except all the big names you see in the headlines, but a little more quiet, frankly, because so many companies got these stopgap waivers that pulled them through Q2, Q3, maybe into Q4. Now we're seeing that volume starting to build back up with companies back at the table, either for restructurings, amendments, or possible bankruptcies.
Thanks, Michael. So on the next slide, you'll see our next polling question. So just getting out of the headspace of that first period of time, which I know was stressful for everyone. So when did private placement issuance pick back up for you? Did it never slow down? Did it pick up in May and June? Did it pick up in July and August? September, October, or has it not picked up yet? All right, so if anyone can't see this, it seems like we're pretty widely dispersed on these results. So about a third of the people thought it never slowed down, and it seems like a lot of other people, 25% around each, saw it pick up in May, June, or July, August. So then going back to the slides, on the next slide, we're going to go to phase 2. So phase 2, we're thinking about mid-April through early summer, where it sounds like a lot of people thought issuance was picking back up. So, the biggest new thing during phase 2 was that governmental assistance and bailouts became a big focus in the market, right? The markets were kind of scrambling to get up to speed on new government assistance that was coming out and new directives and regulations, and figuring out what issuers or companies could access and what that would mean from the debt provider's perspective. It seems generally here that creditors really wanted to support issuers. They wanted them to be able to access this easy money that was maybe cheap and often forgivable, but they wanted to make sure that whatever they were allowing the companies to do and amending their documents to allow companies to do wouldn't really impact or negatively impact their ability to get repaid in the future by impacting their priority and liens. So that was, the source of a lot of amendments during this second phase. The other thing that you saw, as Michael mentioned, by May, June, it became clear that this wasn't going to be a short-term disruption. So amendments started to include longer-term covenant and liquidity relief of the type that I mentioned for phase 1, where relief began to extend through 2020 and into 2021. As issuers agreed to these longer-term relief terms, they also started to think about other ways that they could have the protections that they'd need to make sure that they could be at the table if things deteriorated even further. So during this period of time, you saw the introduction of a lot of new replacement financial covenants that were intended to be in place while there was relief from the regular pre-COVID financial covenants. So you saw minimum liquidity covenants, minimum EBITDA or revenue covenants, and as a result of some of that cash hoarding that we talked about in phase 1, you started to see the introduction of more anti-cash hoarding covenants that weren't typically in a lot of deals, so that if a company did actually have, a decent liquidity position, they could use that money to pay down their debt instead of, just holding on to it for the worst case scenario. So I think, Michael, you've already spoken a little bit about what you saw here, but it sounds like, at least in terms of retail, there more bankruptcy and restructuring activity kind of during this period of time for those issuers that had that weaker performance.
Yes, clearly. And I was really taken this summer by the phrase that Luba mentioned. In all my career, I never heard the words revenue destruction. That's really what happened. Revenue was literally destroyed. And then we saw over the summer, and particularly with the government assistance, basically revenue replacement with debt, right? And if it was your drawdown, that's real debt that has to be paid back. Some of it was tax relief, employee tax relief, and things that helped out a lot of the smaller companies. Interestingly, the ways of Washington, the PPP loans, of course, wasn't necessarily the large companies that we deal with, but the companies that are on Main Street. The bankruptcy bar found it interesting that the Treasury just said, sorry, PPPs are not available to companies in Chapter 11. And I understand the policy and I get it. But if you read the statute, that's not what it says. It doesn't say anything about it. It's just, the Secretary of the Treasury said, I don't think I want to fund Chapter 11 companies. So there's some lawsuits protesting that, but it's going to be too little too late. Maybe if they do another PPP, it might be available. But from a company point of view, if you can actually get revenue replacement through government assistance that you don't have to pay back, that's quite incredible, quite extraordinary. And I can see why Secretary Mnuchin didn't want it to go to Chapter 11 debtors. But I just thought that was an interesting juxtaposition of what the statute says and what the government decided would be best during the summer.
That is really interesting. Thanks, Michael. So on the next slide, the other thing that you saw a lot of during this second phase was playing with EBITDA to figure out what could be done to kind of reflect what was going on in the markets. So issuers really started testing the waters to try to see if their COVID expenses or lost revenues would fit under their existing add backs. And also you would see a lot of amendments where issuers and companies would try to add COVID specific add backs. Obviously the debt holders had incentives to push back here so that EBITDA wouldn't be even less representative than it already was. So things like expense add backs might have been more palatable. For example, if you're a retailer with a customer facing business, maybe you needed to buy a lot of PPE for your employees. That might be something that debt holders would find more palatable, as opposed to lost revenue add backs. And so the bigger question here was, is something really extraordinary when it's ongoing and market wide? Did debt holders want to allow issuers to kind of bunch in a lot of the COVID impact into their EBITDA definitions? Obviously, the answer here was, there was a wide range of what debt providers allowed, but you did see a decent number of debt providers kind of pushing back on calculations in compliance certificates and things like that. The third point here is that there was some, thought put into creative ways to shore up performance given these unrepresentative periods. So for example, you've seen some companies that have annualization of their numbers, kind of ignoring these new periods, or looking at historical numbers, for example, what the quarter would have looked like in 2019 instead of 2020.
Luba, with all this amendments to the EBITDA and the documents and these creative techniques, did these issuers find a way to prevent their rating from being downgraded, or to have a fallen rating stored up? How did the rating agencies react?
So we track documentation, but it's worth mentioning that when we perform credit analysis, we use our own calculation for EBITDA. We have a Fitch adjusted EBITDA. We would not necessarily give an issuer credit for all of the adjustments that it is able to make to its EBITDA based on the definitions in its credit agreement, especially if we don't think that they're realistically achievable. And specifically, since we're talking about COVID adjustments, we would not give credit to EBITDA for issuers' estimates on revenues lost due to COVID. Similarly, also, we would not adjust for costs that we view as likely to be recurring. So, when a company is adding back costs related to or expenses related to COVID, we have to think carefully about, are these likely, to be a 1-2 quarter occurrence, or are they actually going to be something that is going to be costing the company cash for a longer period of time, maybe say 1 to 2 years.
And let me add one thing to Aisha's point there, that one interesting thing that we saw was that investment grade companies, or even those just one notch below, they've never really heard of negative EBITDA. But in workout world, we dwell in negative EBITDA all the time. And we thought it was interesting that, well, how do I measure? What do I do with negative EBITDA? You can still measure it. And I think you still should, particularly when we see companies that we're in this round now starting to come back and they say, well, I think revenue will be, I'll be at 50% of plan, I'll be at 75% of plan by next June, et cetera. How do we reset covenants? We're still having negative EBITDA, but we're saying to companies, we're not trying to punish you, and we don't want to really default you. But if you think your plan is going to rebuild at this level, even if it's negative EBITDA, we should be tracking your plan with some reasonable cushion so that you're buying into your own program as opposed to just a free holiday on covenant compliance. But it's, as I'll talk later, it's a little more art than science, because it's a tension there. We don't really want a company that's decent to default at this point. We're just trying to figure out how to get through the next phase with the right covenants and the right compensation.
Michael. So on the next slide, let's start looking at phase 3. So this is the phase that we're in now, the late summer through early fall. So obviously you're continuing to see amendments around financial covenants, loosening or suspension of leverage covenants and fixed charge coverage ratios. At this point, a lot of these are going into 2021, and you're even seeing certain industries extend now into 2022 as the forecast, as Luba mentioned, on recoveries seems to be more extended. You're also seeing debt providers focus more on what else the companies can do during this period of time when they're in a relief period. So there's a focus on tightening other areas for leakage risk while this underperformance continues. For example, you don't want your company who's not paying you interest because they have a payment holiday to go out and spend their money somewhere else without having you, take a look and consent and make sure that you think that it's the right thing for them to do. So generally, that kind of tightening is lasting until companies get back to their pre-COVID projected levels, and they're looking back at their old pre-COVID financial covenants. Something that we're starting to see a lot more of now is the impact of these amendments on pricing. So there are kind of two different categories of issuers here. There are issuers in certain industries who need extended payment holidays or PIK periods of time because their revenues have just fallen off, and there's a lot of concern that they're not going to be able to make these types of payments anytime soon. And then on the other side, you see companies that are having, that are obviously not, pre-COVID performance levels, but they don't have dramatic liquidity issues right now, so they're able to make their payments. So they might be willing to accept higher pricing terms in exchange for that covenant relief for this period of time. The last thing that we're starting to see a lot more of now is just given the expectations about how long things will last, we're starting to see more maturity date extensions. So you're seeing amend and extend now, where as the crisis continues, companies are not sure that they're going to be able to repay or refinance their debt in the near term. So they're pushing that out in the hopes that that maturity date will then fall after things normalize. So on the next slide, one last polling question here before I turn it over to Michael. So what are people seeing or predicting will happen with the terms of private placement issuances in general? Are people expecting that things will loosen and become more issuer favorable as debt providers look to invest their money? are people thinking that post-COVID terms will generally match up with where we were pre-COVID? Or are people predicting a tightening where terms will become more note holder favorable going forward? We'll give you a second to vote. It looks like here we have a majority of people who are kind of thinking that post-COVID will match up with pre-COVID and those terms will match up, and we have a split for the rest. A little bit more on the tightening side, but a decent percentage, 17%, are thinking things will be looser. So with that, I'll turn it over to you, Michael.
Okay, thank you. And I think on that last question, I just want to comment that Wall Street, of which our institutions are part of the broader definition of Wall Street has no memory, and it will go right back to the way it was, I think, once we're post-COVID. And we don't have, we have to put the money out. It's still going to, I think, be an issuer's market when things return to normal, but remains to be seen. Well, thank you all very much for having me back, and appreciate it. It's nice to see everyone. I'm going to go through some slides here and talk about some of the items we're seeing in restructuring. I would direct you to an outline that's more detailed, that is part of the materials that Ann mentioned, with a thank you and shout out to my colleague, David Riley, who helped me prepare that. We're not related, but I can assure you he's a really good Riley. So with that, I think I'll get to the first slide, please. We've talked about, I should have covered very well what happened this year. So I'm just going to jump, I think, to the bottom line conclusion that all of our institutions are reaching or have reached, and that is the bounce back is going to be slow and long for most companies that are in the wrong sectors, right? And the risk profile for our clients is going to be high and long. And so there's that tension, as I said earlier. We don't want to put companies into default. We don't want to take them back. We don't want them in Chapter 11 unless it's just the worst of circumstances. But we want to have better compensation for the higher risks that we're taking. And I think one thing that's driving amendments a lot right now is the audit opinion, because the auditors are looking at the same thing. They're saying, okay, year end is coming up. I normally want to give you a clean going concern opinion, but I have to, they always look forward a year at least as they give that opinion. But now when they're looking a year ahead, even on investment grade companies or just slightly below investment grade companies, they're wondering, like Fitch is wondering, do they have the cash flow to meet their obligations? Can they meet their covenants? What's their liquidity? What's their headroom, et cetera, et cetera. And we're seeing audit a pressure to have more leeway in covenants going out a year beyond year end, and in some cases 15 or 18 months beyond year end. Particularly in Europe, we're seeing that a lot right now. And it's totally understandable from an auditor point of view. They don't want to be sued, and I mean, in a way, they're sort of telling us something we all know. There's a big COVID risk out there, but they have to put it's part of the audit rules and things like that. But if you look back and say, well, this all started in March, right? The first waivers were in March, April. And now you want me to look out into maybe the first quarter of 22 for covenant relief. Well, that's a 2-year waiver effectively. And we're not being, 50 basis points or 10 basis points isn't going to compensate us for a 2-year redo of the deal. And so what I think is really happening is we're having these very heavy, what I'll call a very heavy amendment. And most people wouldn't call it a workout. I'll go into that in a minute. But in my mind, a heavy amendment is where we look at the debt terms themselves, and it's time to restructure those debt terms. Those covenants are going to change. Some payment maturities are going to change. Pricing is going to change. In most cases where the company is stressed, it's going to be PIK pricing or equity or warrants because nobody can afford the cash anyway, or maybe some grid pricing or bounce back pricing and things like that. We want to get compensated for the risk. I think the only thing that distinguishes that from a workout in the classic vernacular, I think, is that in a workout, we do all that, but we also restructure the company itself, right? Certain business lines have to be closed. Certain CapEx maybe is delayed or deferred, is not all that productive or worthwhile. Maybe there's a reduction in employment. Maybe there's a change of ownership. Maybe we're demanding that the entire balance sheet change with equity or refinancing and those sort of things. Workouts are all about exiting. I want to get out of it. That's why they call it workout. And these, I think, are more heavy amendments where we're just mostly focusing on the debt terms of companies that we think are decent, are going to survive, and need more leeway and time. So let's go to the next slide. I think it's a polling question. Okay. So let's talk about workouts for a minute. The question, at your institution or your law firm, we generally think that a deal becomes a workout too early, too late, about the right time, or it's all over the map. And there's no wrong answer. This is a fun question. So 50% say it about the right time. That's very, very interesting. I see a quarter of the people think it's all over the map as well. Every workout person I know says it always comes too late. It never comes to work out early enough, but that's just our bias. You know, it doesn't make it correct or not. But I will say my definition of a workout is much broader, but it is kind of tried and true. And that is this: would you ask yourself when a company comes for an amendment, ask yourself, would you do the same deal with the same company and the same management on the same terms again? Would you do the deal again? Forget minor changes in interest rate and market and all that. Assume you have a market rate. Would you do the deal again? Lots of times people say, yes, I would do the deal again, but they need more credit for this acquisition, or we're going to invest in a new product line. That's great. But anytime you either say, no, I wouldn't do it again, or, you know, I really don't know if I do it again. Frankly, in my world, you're at least in some form of workout, although that is not a popular name, because you're either trying to work yourself out of a situation by getting refinanced, or you're trying to work your way up the balance sheet by maybe looking at collateral, or you're just trying to improve terms and pricing, because I would not do that same exact deal again. So that's my little definition of a workout, although it might be much broader than most people like. Let's do the next slide, please. Okay. I thought 2020 was very interesting, and we talked about this a few moments ago with these revenue replacement, where all these forms of revenue replacement came from, because it was a wide array, almost like a shotgun array. And I'm not using that in a critical means by any means. I think they were all essential. But you had the PPP, FICA, employer tax relief. Airlines got some subsidies. Some took them, some didn't, because the terms, they didn't like the terms the government was putting on. The Fed, of course, flooded the market with liquidity, and that's why rates are so low, and that's why you saw a lot of private placement activity still continue at high levels, as our poll just showed, right through this whole period, if you were a company that was not as distressed. The personal stimulus checks, of course, that was very important to your typical consumer. The government was providing funds for testing and vaccine development. I think it's extraordinary that they're basically pre-producing vaccines and not yet proven, but they want them to be ready to go, of course, when they're ready. And on the bankruptcy front, as we mentioned before, we've had a ton of retail names, as everyone knows. David Riley and I have been doing we've got 30 large chains have filed this year already and counting. You know, Brooks Brothers, Lord & Taylor, JCPenney, Neiman Marcus. A lot of closings of stores, a lot of debt for equity swaps, a lot of liquidations. And there's the ripple effect. You're seeing the malls are going to be in difficulty as well. I thought it was quite interesting that a couple of the mall owners got together in JCPenney and decided to basically take over the company, put some capital in, because that was the best way to defend their mall, was to still have an anchor store. That's quite extraordinary. Usually it's the creditors that come and own the company. Here, the landlords effectively did. I thought that was quite interesting and quite creative. And in the oil and gas front, as I mentioned earlier, you had this geopolitics war, price war, as well as lower demand with COVID. And the only comment I'll have there is I think that showing, ruthless economics, if you are a low-cost producer of oil or gas, the lowest cost producer, the Saudis, and you see an opportunity to try to take over market share by saying to the United States frackers, well, you can't get anything out of the ground at less than $50 a barrel, and I can get it out for a handful of dollars a barrel. We're going to have a price war. So as compassionate as everyone's trying to be, and I'm trying to blame the Saudis, I'm just saying it's plain old economics. As passionate people are trying to be with their lenders, economics can be ruthless, and we saw a price war right in the middle of lower demand. One byproduct of that in the bankruptcy world, by the way, is that Houston is becoming a venue of choice for a lot of large Chapter 11s and a lot of the large debtor law firms that bring to Chapter 11s. There's two really good judges there because they have a complex docket, and the two judges you're going to get. And I think you're going to see Houston as a venue of the same popularity as Delaware and the Southern District of New York. And that's beyond oil and gas. Neiman Marcus filed there, California Pizza Kitchen filed there, and even Chuck E. Cheese filed there. When I had small kids, we went to Chuck E. Cheese. When Chuck E. Cheese goes, we know it's an end of an era. But I don't think too many of us will miss it. Sorry to Chuck E. Cheese. Next slide, please. What I want to do here was compare, as Luba did with the default rates, the Great Recession of 2008 and 9, because I do believe the bankruptcies will be in that same neighborhood, if not greater. But it's quite a different scenario, because in the Great Recession, Wall Street itself and the money system itself was at risk, right? Our money system almost failed. And you could be a critic of whether or not the TARP programs and the bailouts and all were done right or what should have been done, but our money system almost failed. Here it's Main Street that's failing. The banks and the money system is strong. It's Main Street that is at risk, and that's why we have this wide array of all kinds of bailouts to try to replace that revenue. The other thing I think that I like to look at, and it's the citation to it is in our outline, is studies by Professor Altman, Edward Altman at NYU. He's been around for decades. He has these default scores that he creates. There's a really good video that's cited in our outline if you have a little time to put into it. But I thought it is some highlights. I've looked at him for decades as to tracking defaults, and he had some interesting statistics that I thought I'd bring up here. One that caught my eye the most was that, and he's looking at public debt, mostly high yield debt and public debt. But he also looks at investment grade debt. And he said of investment grade debt out there, BBB, which is our lowest ranking, right, of investment grade debt, is now 55% of all investment grade debt. That just struck me. That's more than half our paper is a notch or two above speculative grade or so-called junk bonds. And of course, what's happening now, whether they're actually downgraded or actually rated at all, many of our borrowers in the wrong sectors are below investment grade. We just know it. You look, you see it, you know it, because their revenue has been destroyed in great part. So as a consequence of that, what I always looked at was what is the public junk bond default rates? Because in my mind, that's a close enough proxy. It's not a perfect proxy, but it's a close enough proxy for fallen angel private placement that was once investment grade, now below investment grade and speculative. And in a typical year, and these are averages, so there's no real typical year, but if I could allow me some mathematical averages, maybe junk bonds default at 3 to 4% a year, meaning of all the outstanding bonds of junk bonds, 3 or 4% would be a default in a typical year. Some years it's 1%, some years it's very, very low. In the Great Recession, in any one year, it was 10 to 12%, depending on how you counted and who you asked. And I thought it was most interesting that so far in this year, at the end of August, our trailing 12-month average, was already near 9% of junk bonds. Full year predictions, again, depending on who you ask, is 15 to 20%, which is an incredible high amount, which I think may even exceed 2009. And as Luba's slide showed, Fitch believes those 3-year cumulative averages will be about the same, if not a little higher. And so let's go to the next slide, because that was also, I thought, a fairly sobering slide.
Let's pause for a moment to go through for the next code. So if everyone could get something to write down the next code. The next code is 54802. Again, it's 54802. Thank you.
Okay.
Mike?
Yep. This slide, again, to me was sobering. We looked at 2009, and I look at all the cases of over 1 billion of debt, 1 billion of liabilities. There were 49 in all of 2009. In 2020, at the end of August, we already have 48. So we're equal there. And as Luba mentioned, is because there's just a lot more leverage out there. There's a lot more debt on the balance sheets in general. But this is looking at number of companies. So even if I have 5 times more the debt I might have had in 2009, the same types of companies are failing. And for cases over 100 million, what would be called the so-called large Chapter 11, in 2009 we had 153. So far we have 137. I think it's easily going to surpass that number. Of course, some of that's from COVID, some of that's from higher leverage, and a lot of that's just easy money was out there at low rate. But easy money isn't so easy if you don't have the revenue, as we all know. You need the cash to pay the debt. Okay, let's go to the next slide. Okay, so restructuring strategy, what we call COVID edition. Couple of watchwords here. I'm a workout person, but I know not every amendment is a workout, despite my definition earlier. There's a whole headset of how we approach the deal. We want to support a borrower. But I would also say that not every workout needs to be a disaster. And particularly now, it's a renegotiation, a heavy renegotiation of debt terms. But the advice we like to give is that every amendment is your opportunity for scrutiny of your company. And again, not in a punishing way, not in a accusatory way, but if you look back when you circled the deal, ask our clients, did you have much diligence? Did you get much information other than the booklet? If you asked too many questions, did you get left out of the circle? If you tried to change too many terms, did you somehow get left out? Usually the answer is yes, right? We don't, in our industry, we don't have that kind of diligence that we do on a new deal. I'm old enough to remember being sent, believe this, sent on a diligence trip. We would go to the company, go to the issuer, look at their contracts, look at that. That's decades gone. When I was a young lawyer, that's what young lawyers did. We don't have that anymore. You get the booklet and that's it. And so what we like to say is the amendment is your really first chance for good diligence on what your company is all about. How do your operations work? How does cash flow work? You understand better, frankly, how the covenants work and what pushes and pulls all the levers that make that make them effective. And so I like amendments, if you will, and I don't mean workouts, I mean amendments, because this is an opportunity to really get to know our borrower much more closely in the first instance. Okay, next slide. All right. So what we're seeing right now is these are my phrases. I just tried to come up with something that might be easier to remember. Some companies are a struggling survivor that we think is going to live and we want to support. And unfortunately, other companies are the old melting ice cube or the walking zombie. It's all about staying power, right? We all believe, let's hope, we all believe this will have some end. It may not be back to a total normal, but it will be far different, we hope, than today. It's going to end. If so, we have to pick which companies we think are going to survive that. And do they have the staying power to get there? And we're part of that staying power as to how they get there or not. Staying power depends, of course, on a lot of things. What industry they're in, as Luba pointed out, travel industry is terribly down, but home improvement industry is up. So, some businesses are doing better in this environment. Your competitors, and the reason I say that is that we always see this in every industry. There's usually a top 5 or a top 10 companies in any industry, and everyone's trying to move up the chain that I want to be higher in the better companies, which is terrific. But as any company moves up the chain and being the top 10, somebody's moving down, whether they're doing it on purpose or not. And it's those companies that are more the bottom of their industry. They have little less revenue, little less customers, little less headroom. They're the ones that are going to trip up sooner and maybe not be the same survivor that we would hope. A lot of that depends on management skill. And I think if we ask most of our clients, what's the key factor for getting repaid in a deal, is not only the asset base itself of the company, but management. What is their skill? What is their dedication? What is their creativity? And are they staying ahead of the curve? And it's a real art form, because it's easy for us to criticize in hindsight, but management is really a key in whether or not we're going to get repaid in most cases. And then where we can come in is helping out on the liquidity side, helping out on access to capital. That's part of our role. But as Luba said, those companies that have more access to capital, and Aisha said, drawing down on the lines, or at least knowing your line is there and the bank's not going to pull it because of material adverse change clause, that sort of thing. That is key, because this is probably going to take, I just said, I hope it ends in 18 to 24 months. I'm probably wrong. So we have to have a longer look ahead at sort of looser terms for companies we think that are going to survive. In a minute, we'll talk about how we get compensated for that. Unfortunately, for the other side of the coin, the melting ice cubes, the zombies, it never usually gets better. We have to take our lumps. It's just, it's just not necessarily going to get better. And we can, right now, though, we're still amending and extending. And there's no, if a company can hang on a little bit, there's no reason to put it out of its misery, that there's a chance of comeback. And I don't mean to sound so callous, but I think you all know what I mean. But amend and extend, in many cases, just means pretend, right? We're just hoping, we're pretending. But we might wait. I think we'll see more of those kind of companies in 21, decide whether or not they have a reason to live. We're going to see a lot more retail, I think. I think we're going to see some hotel chains that just aren't going to hang on long enough. I don't know if many people are going to take a cruise anytime soon. So I think there's some of those kinds of activities. I just don't think we're going to see them around in the same way that we did before. Okay, so let's move on to the next slide and get a little more detail on the struggling survivors. Okay, so here's, I think, is an interesting challenge, because it's a little more art than it is science, because there is a tension I mentioned earlier. Company needs liquidity, needs headroom on its covenants. Sometimes we call it runway, although that's an ironic pun these days with the travel industry. They need room. Yet to do that puts us at higher risk, particularly most of these companies already below investment grade. And so it's not in our gut nature to say, oh, good, let's just loosen the covenants. We don't like to do that. We wish we were coming back to investment grade. I think it's going to be quite a while before a lot of companies see that. So our next reaction is, okay, if I have to take that risk, and I understand it, and I will take it, but I want to mark to market. I'm not doing a 2-year waiver for 50 basis points. It's just not the way I think. You know, we, of course, have reserves, higher reserves. We have NAIC 3s and below investment grade. And so it costs our clients, costs you money. And we want to have some mark-to-market pricing. But the very companies I'm talking about, they don't have cash. They don't have it. Can't get it out of a stone. So we're looking at all kinds of PIK interest on PIK interest, looking at warrants, also kind of pressuring companies saying, you know, maybe you ought to be issuing some equity. Even if your stock is low now, I get it. You don't really want to issue stock when it's low. But I also don't want to be a below investment grade credit, giving your equity a free ride, a free option at my expense, if you're not going to in a position to compensate me for the below investment grade debt that I have. So that's the tension and an art form, if we will. If we try to look ahead, because we're trying to create amendments that could possibly last 1-2 years on that very spectrum and that parameter. And that's a judgment call and a negotiation that just is, it takes a while to take place and get it just about right. And we often find in early amendments, amendment number 1, usually we don't have a right. Usually there's amendment number 2 somewhere down the road, even amendment number 3, as Aisha mentioned this summer. And for most of our issuers, of course, we don't know necessarily the answer. We don't know if they're a survivor. We don't know if they're a zombie. And so we have to price it for today's risk. We have to look at the downside, and we're going to mend and extend and hope for the best. One thing that I like to do, and it doesn't sound like it's very enforceable or very a lot of contract teeth, but I find it's fairly effective, is when companies are trying to rebuild their business plan and they're slowly edging back above water. I like to have quarterly, sometimes monthly, but sometimes more often quarterly conference calls with management, which sounds like, what does that do? What we find is that it's just human nature. No manager or executive wants to go to a conference call with their lenders, and the lenders say, how did things go in the last quarter? Did anything improve? Did you do anything to improve plan? Nobody wants to say, nope, did nothing. No, we didn't pay attention. Doesn't matter, right? They all want to say, yes, we did stuff. We did. And so I think that just gets more personal accountability between lender and executive. Again, not hostile, not punishment, not accusatory, but just more of a relationship, because those same people are going to come to the table again later and say, okay, is this forever? This a long-term deal? We're never getting back to where we were? Or are we have new normal? And I think having a relationship helps. And I think having some personal accountability among the people in your deal helps in just terms of moving that ball slowly down the road and trying to look ahead to the next amendment.
We're running out of time here, Mike. So.
Okay. All right. Well, let's do our final poll question, or you want to skip that? We'll do it. Okay. At your institution or your clients, do you think workout recoveries ultimately are lower than you initially expected, higher, about what you expected, or all over the map? Let's see, we have all over the map and about what you expected. Okay. Maybe I'm an optimist. I usually find they're a little better than we expected at the beginning, but let's move on. And I'll just very quickly do the last slide, Ann. I just wanted to remind people that many of you probably haven't looked at your bankruptcy code or your bankruptcy primers in a long time because you haven't had a lot of bankruptcies. Reminding the bankruptcy code was built for this. Bankruptcy is a viable option for most companies if we don't give them the room to stay out. And most of the time, we're better off if the company stays out of Chapter 11. We can keep interest accruals. We can block more debt coming in. We have more say over debt, more say over liens, which in bankruptcy we don't. So I think every workout is done in the backdrop of what would happen in bankruptcy, and almost every workout is designed to be better for the company and better for you, for us, out of bankruptcy as well. And but I think we're going to have to pull out our bankruptcy codes again as we go forward into 2021. So with that, Ann, I'll stop and we can take some questions at this time.
Thanks. Are we going to have any time for questions, CJ?
No, unfortunately, we're not going to have time for questions. If
Okay,
someone
well, I
has
think-
questions, they can email you or they
Okay.
can email CLE@aciclaw.org and we will be able to answer there.
Okay, there were some questions in the chat, so I don't know if those somehow have been captured and then we can answer the people separately.
Yes, absolutely.
Okay, thank you, everybody.
Good. Thank you all.